Go ahead and accept that. And guys, forgive me, I have like this streak of light coming through here that I'm going to try to eliminate. I hope I'm going to be successful in that. Sorry. I've taken care of that before. I switched the streak of light from one side to the other, so it's just something that we'll just have to roll with here. Sorry. Okay, it's what it is. Nothing we can really do about that. Okay, so let's go ahead and get ourselves going here with chapter 2 and put up the PDF. Okay, and we're really going to start to get into financial management. You're going to see that quite a bit of what we're going to talk about is going to be similar to things that you learned in your finance class. And so we'll talk a little bit about capital structure. Capital structure, going to be about 5 points. Again, they break these into 2 areas primarily, just to have more bite-sized modules. So I kind of put those 2 areas together as a 5-point area. We're going to talk about working capital. Okay, and you're going to see that there's going to be quite a bit discussion. And we talked a little bit about some of that section last time, so we won't have to review. I think it was that part 2 we had started to look at. We won't repeat that, but you'll see that many of these working capital metrics deal with financial ratio that will allow us to evaluate the performance of the company, looking at things like the current ratio, some of these other things. Then we'll get into financial valuation methods. And again, a fair amount of ratio analysis there. And we see that that comes up quite a bit, not only in the BEC exam, but also in FAR and regulation. So pretty much we're going to have to memorize different formulas that are used for financial valuation, make sure we're comfortable with those ratio by memorizing them, and make sure we understand what they might be indicating about the management of the company. And then financial decision models really start to get us into and really lead us into chapter 3 as we start getting into managerial accounting type things, as we start talking about net present value method, payback method, different ways of making business decisions. You probably learned those in your managerial accounting class, and you might have had them in your finance class as well. So let me give you a sense as to some point values for some areas here in chapter 2. Excuse me, guys, I've been suffering from allergies a little bit, so I may be a little bit sneezing, so I apologize for that in advance. But taking a look, we're going to really cover most of that here in chapter 2. We'll get about halfway through that today. I'm thinking we should be able to get through these first 5 modules, and then that'll allow us to finish up next time for chapter 2. Make sure that you are keeping up with your homework. We're doing about half a chapter per week, so you should be completing about half a chapter per week on your homework. Okay. All right, so let's go ahead, and they start us out talking about different types of financing instruments. These are largely definitional. I'm not going to go through these. If you run into a question here where they want you to understand something about debt and versus versus leasing versus financial vehicles such as equity, I think you can take a look at those on your own. I don't think that I need to sit here and just read off a bunch of definitions to you, which is all they're doing here. Okay, so what I want to do is start us in the second section here of our first module, dealing with the weighted average cost of capital. Now, when we talk about the cost of capital, there's consideration really of three components. One would be if you're going to borrow, the cost of that borrowing. You have some project, you decide you're going to go ahead and have to borrow for that project. The cost of that capital would be the interest that you have to pay on that borrowing. If we're talking about financing through preferred stock, the dividends associated with preferred stock would be the cost of the capital. And if we're talking about using common stock as a vehicle for financing, then we're going to be looking at some different models that will help us. And the way they characterize that as the cost of using retained earnings for our project, whatever it is. And what we try to do is come up with a mix of these different vehicles, common stock, preferred stock, debt, to finance a contemplated project, maybe some sort of long-term construction or something like that. So you take a look here and they tell us that the weighted average cost of capital serves as a major link between the long-term investment decisions associated with the corporate capital structure and the wealth of the corporate owners. Obviously, we are trying to reduce that cost of capital, reduce the cost of capital for a project. That's going to obviously be more profitable to the company. Okay, so the weighted average cost of capital is often used as an internal hurdle rate for capital investment decisions. Now, we're going to look a little bit later at, for example, the net present value method. Well, what interest rate do you use when you're discounting cash flows for a net present value method? Often it could be this weighted average cost of capital. Although in CPA exam questions, they'll probably give you the interest rate. They won't make you calculate a weighted average cost of capital that make you do a net present value evaluation. If we're talking about internal rate of return, they will talk about the hurdle rate associated with that. And again, the way that rate is often developed is through the weighted average cost of capital analysis along the lines of what we're going to be doing here. So let's look at this passkey, and they also say it up in the paragraph, but since they bothered to break out a passkey here for us, let's just go ahead and highlight it here in flashcard that the mixture of debt and equity financing that produces the lowest weighted average cost of capital maximizes the value of the firm. Now you see a term like maximize and you think, oh, okay, they're going to do some sort of mathematical derivative to come up with, you know, what the ultimate mix is. No, there are many considerations that might go in to this evaluation. Maybe we don't want to use as much common stock because we don't want to give up control of the company. So we might move more towards a common stock or a debt instrument or something. So it's the not only the financial consideration that goes into this mix of debt versus equity. And again, when we talk about equity, we're talking about both preferred stock and common stock. Okay, so you start to take a look, and there are elements to the calculation of the weighted average cost of capital. And you can see that we have a factor for each particular, each specific type of capital, okay? And you can see that we have three different sources that I've been indicating. We have common stock, which is represented by the term E here. We have preferred stock, which is P, and then we have debt, which in this particular formula, as you can see, is the D. Okay. Now, what we do is we have V, and V is the sum of the three components that we're talking about, whether it be the common stock, the preferred stock, or the debt. So it's the sum of E plus P plus D. And then we go ahead and we then put in the numerator here each one of those elements. Okay, so you can see we have E, we have P for the preferred stock, right? And then we have D for the debt. Now, of course, debt carries with it what? Carries with it an interest rate. Okay, so R is the required rate of return. Okay, now we call the required rate of return That's not our required rate of return. That's the required rate of return of whoever we're getting that capital from. Okay, so in the case of debt, for example, the required rate of return is going to be the interest rate. But notice what we do here is we go ahead and we multiply that by 1 minus, and T is the corporate tax rate. Now we're doing that because interest is tax deductible. So once we have shielded that so much income because of our interest expense, our interest expense is what is going to be reduced by the tax benefit. So to really get the true interest rate after tax, we multiply that times 1 minus the tax rate. Okay, and then the required rate of return for the other elements that we have here will be based on what the requirements is for our preferred dividends. And then when we get into the discussion of common stock, we have various ways of evaluating the cost of using, and they call it the cost of using retained earnings, because we're basically going to be looking at various dividend structures and see how those affect the cost of the common stock. Okay. Now, what you're going to need to do is you are going to need to flashcard this formula. It's a little bit daunting. It's got a few elements to it, but I think the logic of it is pretty easy to understand. And once you've worked with it a couple of times in some of the questions, even one that we'll do tonight, you'll get used to this and it'll be pretty easy for you to remember the elements in calculating the weighted average cost of capital. Now, when we look at this particular example here, they call out what the weighted average cost of capital is for each, or what the cost of capital is for each one of these. In some cases, we may have to calculate that, particularly in the case of the common stock, but many problems just call out and they just want to see if you know how to combine these to come up with the weighted average cost of capital. So assume the common stock equity of the company XYZ is 8.4%. Okay, so they just gave it to us right there. Now, if the problem just gives it to you, you say, thank you, problem, and you're done. You don't have to sit there and use one of these models like the capital asset pricing model to come up with that number. The cost of the preferred stock, again, there are ways to calculate that, but this question was very nice to us. It just gave it to us. And then they say the weighted average cost of the interest rate for the debt is 6%. Now, the problem will always give you that. You know, you're not going to have to be able to calculate an interest rate on these. I guess you could, but they won't make you do that. They'll just give you that. But in this particular question, notice they tell us what? They tell us that the corporate tax rate is 30%. So just looking right here at the cost of the debt, we will have to adjust that to an after-tax number. And most problems will require you to do that. They may give you the average after-tax number, If they do, that's fine, but often they'll make you calculate that. So after-tax for the debt is 4.2%. Now, what we're going to do is see that and they tell us here, they just give us the number that it's what, 55% common stock, 20% preferred stock, and 25% debt. So now all we have to do is sit there and pick up those cost numbers that were pretty much given to us. We had to calculate that one, of course, right there. And then we apply the relative percentages that were given, okay? And so the weighted average cost of capital is 7.03%. Question. Okay. All right, good. So what we're going to do now is understand the individual components that we've talked about, okay? And we're going to talk about long-term here versus short-term. And so long-term items are the items that we've talked about. So the notion is that if you're going to be borrowing money and whatnot, you're probably looking at a longer-term project, so you would consider these longer-term elements. Now, there are shorter-term ways of financing things, okay? And so you can see that there could be interest-bearing type of shorter-term financing, but then There's also, whether we realize it or not, when we're using accounts payable and whatnot, those are actually financing vehicles. They are shorter term and often they do not carry interest with them. Okay. The only thing is be careful. Okay. Don't assume that. So you can flashcard that, but then be careful. Always look for a trick on the exam where they may give you an interest rate on something like this that typically doesn't have interest. Not interesting. I don't know if it's interesting. Always look for an interest rate on these because the exam might try to trick you again. You're studying for the CPA exam. They want to see, are you a person with attention to detail? So just don't assume that account payable doesn't carry any interest with it, but most of the time it will not. Okay. Okay, good. Now you come over and let's take a look at the weighted average cost of capital now. And we're going to look at each one of these, starting with the weighted average cost of debt. And guys, it's pretty straightforward here. The weighted average cost of debt is the effective annual interest divided by the debt outstanding. So flashcard that because the question may, although that other question gave it to us, right? And then we had to remember to adjust it for after tax. But, if they don't give it to you, they would have to give you these elements so that you could calculate that number. Okay. And again, as we've stated, you need to adjust that for after tax. And the way you adjust that, the way we saw in the little example, we're not giving you anything new here, but you could flashcard it. Here is to go ahead and multiply that number by 1 minus the tax rate. That's telling you the true interest that you're paying out after you have considered the tax benefit. Okay, now I'm not going to go through that again. We kind of went through that already in the previous problem. So they're just showing you there how to adjust that to the after tax number. Okay, good. Now you come over and the next element is the cost of the preferred stock. Okay, I'm just going to jump straight down to the formula here. You can go ahead and flashcard that, which is to take the net proceeds of preferred stock, divide that into the preferred stock dividends. That's the cost of using preferred stock. So very, very, straightforward there on that particular one. Now, let's take a look though at preferred stock dividends. Okay, so let's look at each element of that, the preferred stock dividends, and then we're going to look at the net proceeds from the preferred stock. Okay, and understand a little bit more about those elements of it. We're going to flashcard how we figure that out. And preferred stock dividends, as you probably know, guys, can be stated as a dollar amount or a percentage. For example, 5% preferred stock pays an annual dividend of 5% of par value if dividends are declared by the corporation. Okay, so you can go ahead and flashcard that. And then the note proceeds would be if there are any sort of adjustments that happen to the for a flotation cost on that preferred stock, then we would have to take out those flotation costs. Flotation costs being costs associated with issuing the preferred stock. We had to pay some sort of underwriter fees or something to that extent. Okay, now you come over and you take a look at this example, which is pretty easy. We have that the preferred stock, okay, for the firm is 10%. It's $100 par value, and we have $5 per share flotation cost. Okay, and so what happens? We go ahead and we calculate the preferred stock dividends per share, and it's the 10% times $100 par value gives us the $10 for the dividend. The net proceeds, okay, not shocking, would be the par value minus the $5 flotation cost the question gave us. We do the math on that, and so the cost of the preferred stock is 10.53%. So you look at the cost of capital for the debt, the cost of capital for preferred stock, pretty easy. Okay, Where it gets a little more entertaining for us here is when we start talking about the cost of, and they're calling it the cost of retained earnings, but really it's dealing with that final component of the weighted average cost of capital, now the cost of using the common stock. And sometimes they'll call that the cost of retained earnings. So the cost of capital, equity capital obtained through retained earnings is equal to the rate of return required by what? The common shareholders. So why don't you go ahead and flashcard that in case someone gets silly on you and calls it, what's the cost of retained earnings? Well, that's going to be the common cost element of the capital asset pricing model, but the weighted average cost of capital. I slipped into saying CAPM there because CAPM model, the capital asset pricing model, is one way of figuring out the cost of retained earnings, which means the cost of using common stock. We could also use something called the discounted cash flow model. We could also use the bond yield plus risk premium model. Or we could, although I would predict you won't see any questions that ask you to do this, you could use all three of these and then come up with the average of these to come up with your cost of common stock, or your cost, otherwise known as your cost of retained earnings. Okay, now let's go ahead and let's just look at the capital asset pricing model. Okay, let's just kind of look at, and they call it key assumptions. I think it's useful for us here. I don't know about it, but that doesn't feel like key assumptions to me when I read it. But I think it's worthwhile us reading through this together, because what we start to see here is understand what the elements are that go into that CAPM by reading through this. So the cost of retained earning is equal to the risk-free rate of return plus a risk premium that is specific to this company. Okay. The market risk premium is equal to the systematic non-diversifiable risk associated with the overall stock market. And then we either amplify that or mitigate that by the beta coefficient. Okay. Now, if we have a beta coefficient of 1, that means that our stock is just as volatile as relates to the market as the overall market. If it is greater than 1, then that means we have more risk than the overall market risk. And if it's less than 1, that means our stock is not quite as volatile as the market. Okay, so it's a way of amplifying or mitigating the market risk through the beta coefficient. The risk premium is the stock's beta coefficient multiplied by that market risk premium. And then what we do is we take the risk-free minus the company's specific, we take the risk-free and we add the company's specific risk premium to that to come up with the capital asset pricing model's cost of calculation and cost of retained earnings. So it's risk-free rate plus the risk premium. Then to figure out what the risk premium is, we take the risk-free rate, or figure out our cost of retained earnings, we take the risk-free rate, and to calculate the premium, it's the beta times the market risk premium, and then we go ahead and we take the risk-free plus the risk premium, which is the beta times the market rate of return minus the risk-free rate, and that allows us to figure out what the cost of retained earnings is. And I don't think I said that exactly the way I wanted to, but flashcard that. And let's just look at an example as to how we'll use that. And I think it becomes pretty clear to us despite my clunky explanation of it or description of it. So let's go ahead and take a look. And we say, assume the firm's beta is 1.25. Risk-free rate of return is 8.75, and the market rate of return is 4.25. Okay, so we know that we're going to have that 8.75. I mean, when we get that 8.75, we know we're going to ultimately be adjusting that for the risk premium. Now, how do we get the risk premium? We go ahead and we take the market rate, which is 4.25, and we subtract off the risk-free, so we just get that premium. But then we have to multiply that times the beta. So apparently this stock is what? More risky than the overall market. Okay. Once we have gone ahead and made that calculation, we could do this sort of work, inside the parentheses first. That's just a math thing. And then we go ahead, we have that risk premium, we multiply it times the beta, and that tells us what the risk is that's associated with this particular company over and above the risk-free rate of return. And so we know now what the capital asset pricing model is telling us is the cost of retained earnings, the cost of using common stock. Again, that's one of three options as to how we would calculate that cost of retained earnings. Just as a side, I have friends, I don't call them friends. I run into people around the time that, they'll be talking about the debt ceiling. And there's people that sit there and they say, oh, it's okay if the federal government defaults on its debt. And I'm like, no, it's not. We have to have some measure of stability, some basic measure. And we use this risk-free rate of return as generally what's being charged for treasuries that would match the length of whatever it is that we're considering doing. So we find a treasury instrument, risk-free, the government's not going to default on its debt, and then we start to adjust from there. So, in order to have orderly capital markets, you have to have some level of stability. And that stability is that the federal government will not default on its debt. So if you run into people that start telling you it's okay for the government to default on their debt, you might explain to them the way the capital asset pricing model works, and explain to them, how that would really affect the way our entire economy makes business decisions as to how they're going to finance long-term investments and that sort of thing. Okay, now you come over and you take a look at discounted cash flow. Okay, method. Okay, now this gets a little confusing because ultimately we build this whole thing as coming up with the cost of retained earnings. But then we're going to see that they come up with something that they're calling the cost of retained earnings, which seems a little, I don't know, a little out of place to call it that here. And then we pull it into the discounted cash flow model. So I guess we're talking about the little cost of retained earnings as opposed to the big cost of retained earnings, which is defined or calculated, I guess, by using the capital asset pricing model, the discounted cash flow, and the bond yield plus risk premium, which we'll talk about later. So don't get those two confused, even though they use the exact same term. It's pretty easy to get them confused. So let's take a look at some of the key assumptions. Stocks are normally in equilibrium, okay, whatever. The estimated expected rate of return will yield an estimated required rate of return, okay. Right here, the one that's more interesting to us here is the expected growth rate may be based on projections of past growth rates, the retention growth model, or analyst forecast. You know what? Note to self, I don't care about those key assumptions. I'm not going to read those anymore. I don't see that those are really, I don't know why I asked you to highlight those. Okay, let's just look at the cost of retained earnings. And we go ahead and we say, well, what are the dividends per share expected at the end of the year? What is the current market value of the outstanding common stock? Okay. And what is the constant growth rate in dividends? And again, a problem would give us all of those. So you take what's currently going on and then what is the growth rate, and that is what we're calling the cost of retained earnings. Now, again, the way it was set up for us, we were saying that the discounted cash flow is one way of coming up with the cost of common stock, which we were calling the cost of retained earnings. Then all of a sudden we pick up this piece and we call it the cost of retained earnings and plug it into the discounted cash flow model. So be careful with that. That gets a little confusing, I know. So you come in and we come in with this cost of retained earnings here that we're going to calculate. Okay, and so we start out with what you can flashcard this right here. We have the D1, okay, that we need to calculate for this calculation. We've got to come up with this D1. So you need another flashcard here to come up with this D1. And D1 is D naught, D0, plus the constant growth rate. Okay, so what happens? They may make you calculate that D1 so that then you can plug that into the number up here for the discounted cash flow method, which will give you the cost to retain earnings here. So they tell us, let's just look at the fact of the problem here. Assume that a firm is a constant growth rate of dividend, and the dividend is $2. That's a D naught. Dividend growth rate is 7.5%. And the current market price for the stock is this $2.25. So $25.25. So now coming up with the cost of retained earnings here using the discounted cash flow model, right? We have D1 plus 2 times 1.075, and we come up with the $2.15. And so our cost of retained earnings here now using the discounted cash flow method would be to take the, and we saw that formula up there, the D1, and we come up with the D1 divided by the P naught. Here we had to come up with that D1. Okay, so you see how they got that. Okay, and then we go ahead and add in the growth rate, and that gives us here this the 16.01 discounted cash flow way of calculating the cost of retained earnings. Okay, good. Then we come over and we talk about the bond yield plus risk premium model. And, you know, this one is really just, you have to read the problem and see what they give you as your numbers. So now the cost of retained earnings here, and you can flashcard that using this, is pre-tax cost of long-term debt plus the market risk premium. So assume the firm has an estimated market risk premium of 4.5 and is determined the yield to maturity on its bonds is 11.34. That's the yield that the bond is going to provide to whoever the person is that bought our bonds. We add in the market risk premium here, and that gives us the answer. So that's pretty easy. Okay, any one of these would be ways of calculating the cost of retained earnings. I'm thinking that when you look at questions, they're either going to give you the elements for the common stocks cost, okay? And then they may make you calculate the cost of the debt associated with the mix that they're talking about for the weighted average cost of capital. Or you may see a question which they just ask you to use, and probably they're going to focus on the weighted average, the capital asset pricing model, excuse me, to make you calculate that. And then they may make you plug it into the overall calculation weighted average cost of capital. They may stop right there. Okay. Okay, good. So, before we move to the questions, not a big deal, guys. You could average the three methods. Okay, so maybe you use all three methods and then you go ahead and average those three, and that's what you use in the cost to retain earnings. Question. Okay, good. With all that, then let's go ahead and put up our first question for tonight. We're at 2 minutes. I've given you more time on this one. Okay, guys, I'm going to go ahead and end the poll here, although most of us didn't get a lot of us didn't get a chance to answer this one. I think the problem is that there's an exam trick in here that messed us up. Okay, because the answer here is most of us who got it right. The majority of the class got it right, but I'd like our percentages to be a little higher than that. But this is kind of a tricky, weird question. Okay, so let's just go ahead and let's take a look at this. And by the way, guys, if you're looking at a question like this, because out of the 11 participants, there's a couple of us who decided to sit on the sidelines in this. Do not do that. Okay, sit there. If you get confused on a question, keep fighting. Keep fighting through the question. Keep trying to get to that best possible answer. When you start to hit that 3-minute mark, which is about where I cut you off, make your best choice. You need to get used to, throwing your hat into the ring on these questions and making that choice. So don't not answer just because you think you're going to get it wrong. Okay, now you come over, you get positive points for everything you mark correctly on the exam. You need to have that discipline to do that. Now you start looking at this question. You've got some choices for all 4 letters here. Okay, but you start to look and they set you up. Okay, and that they start giving you the elements that you would need to calculate the cost of retained earnings by using the CAPM model. And then they start giving you the elements that you would need to calculate, well, what's the after-tax cost of the debt? And they give you all of that. And then at the end, they just tell you, assume the after-tax cost of debt is 7% and the cost of equity is 12%. So they run you through all of that garbage. I'm calling it garbage because it's not useful to answer the question. And then they just give you the elements you need. So I know what the 2 costs are. The cost is what? After tax for the debt is 0.07. And after tax for the equity, for the retained earnings here, it's 0.12. They told me that. Okay. So now I simply need to weight each one of these by how much debt versus how much equity, how much stock. And they tell me they need a total of 50 million. So I know that 50 million needs to be in the denominator for both of these, the debt and the equity. And then they tell me that what? They tell me that what? 15 million is going to come from the debt of that 50 million. And what? And 35 million is going to come from the equity of that 50 million. So I'm weighting these costs appropriately by the mix of debt and equity. And when I do the math, and guys, when I do these, I do the math individually for each one of these. Don't try to like sit there and make your calculator figure out all this, as you're going to get messed up. Figure it out for the debt, figure it out for the equity, and then add them together. Otherwise, your calculator is going to do something funky on you. So you do what? 0.021 plus, that's a 0, 0.021 plus 0.084 is what happens when you calculate each one of them separately. And that gives you 10.5%, which was choice A, which most of us got. Okay.
I think
So,
that'd be a good example for one that you should just read the whole question before starting it, I guess.
well, yeah. Before, yeah, read the whole question always. Yeah, before, yeah, okay, I see what you're saying. Yeah, absolutely. You should do that. I always do. They sometimes they say look to maybe the opposite of what you're saying, which is if you just read the call of the question, the last part of the question, you wouldn't have had to bother yourself with all that, because I hear that a lot of times. But I'm not sure, is that Donald? I'm not sure who, was it Eric? I'm not sure who called that out.
That was Eric.
Yeah, that was me.
Donald Eric. You know, I have trouble with that. To be honest with you, I've never been good at reading the last part of the question. Said, oh, ho, ho, and then quickly going through. I have to read the whole question. I always have to end up, what are they asking me to do here? And I kind of have to go, oh, well, here we go. And now they're just giving those to me. I don't know. I find a question like this a bit unfair. I really do.
Sometimes they suggest you read the call of the question first. Do you think that makes
Right.
sense?
No, I'm not. That's what I'm saying. I'm not good at that. I'm generally not good at that. The only time that I would advise doing that for the BEC exam anyway is when you're doing variance analysis. What variance do they want me to calculate? Because they'll give you a lot of different things in those questions, and it is helpful to me to know which variance they're ultimately going to ask me for. So sometimes I recommend for the variance analysis, look to see what the variance is they're asking for, because you start to get a sense, uh-oh, here comes a variance analysis question, because they start telling you the standard price is this, the actual price is that. You're like, uh-oh, here comes a variance question. I like to just peek down for those and see what the call of questions asking. Then I'm better able to start to pick out the elements that I want without having to read through the whole question. But for the most part, for me, guys, I got to read the question. I got to get a feel for it. You don't have to sit there and pour over DQZ, no telecom, is considered. Quickly read it. Give yourself maybe 15 seconds to quickly read through, get a feel for it, and then start to go through to really understand what you're supposed to do here. But as I was saying, I think this is an unfair question. The examiners, why do they do this to us? They give us all the elements for the capital asset pricing model, and then they just make you throw all that away. And that's just a little unfair, in my opinion. What are you going to do? We're not going to win any argument with any CPA exam question. They always win. Plus, the capital asset pricing model, in my mind, is kind of fun. Maybe I'm sick there, but I think it's kind of fun. And so, your feeling is, oh boy, I remember the capital asset pricing model, and your sense is to start using it like you would in this particular question, where they absolutely tell us, hey, use the capital asset pricing model. So let's go ahead and practice with that. Okay, guys, I'm gonna go ahead and end the poll on this one, so please make your choice. Okay, and we've got 8 folks participating, so there's one out there that's not, or is that me? I guess that's me. So I'm not doing it. Let me see. 1, 2 is 8 plus 3 is 11 minus 2 is 9. Okay, so there's still some folks not participating. Don't give me the mode where I have to start calling out. Okay, but let's go ahead and take a look. And most of us got this right using the capital asset pricing model. Now, when you take a look at this, okay, you can see that they tell us the risk-free rate of return is 6%. Okay, so we know we're going to have to use that. Okay, so we're going to put 0.06 in this capital asset pricing model. Now we're going to adjust that for this risk premium here, and they tell us that the market rate of risk is what? Is 14%, but then we have to figure out that we have to amplify that for the beta, which they tell me is 1.25. Okay, so when I go ahead and I just simply, and then of course I have to just amplify the portion that is for the market return. So take that 1.25 times, but I have to subtract off what to get the risk premium. I have to subtract off the risk free. Okay, and when I do the math on all that, I get this correct answer here, which was what, 16%. Okay, we had one choice for 14%. I'm not sure where 14% came from, but we'd have to adjust that market rate of return appropriately for what's going on with the company, and then of course backing out the risk-free. Okay, question. Okay, all right, good. Let's go ahead then and let's start to take a look down here. Sorry guys, I'm having trouble reconciling something. 1, 2, 3. It's 12. It doesn't have 12 participants, but why is it counting me as a participant? I guess I get counted as a participant, so I should be getting 10 responses on the multiple choice questions. Okay, sorry, I'm talking to myself there. Okay, let's go ahead and let's jump ourselves into module 2 now. And we're going to really start to get primarily into some ways of analyzing the various elements of capital and really start to get into some ratio here. So we are looking for the optimal capital structure, okay, which is the one that's going to give us the lowest weighted average cost of capital. And again, it starts to sound like there's some sort of, derivative or something that you could take that would allow you to come up with this. That's not what we're doing here, because there are a lot of considerations that might go into deciding what it is that we want to do in terms of the mix of debt and equity. And as you saw in those questions, they tell us what that mix is. The 30, whatever it was, for the 50 million, 35 million was going to be debt, 15 million, 35 million was going to be equity, 50 million was going to be debt, whatever we saw. Okay, so they'll give us that mix. Now, when we come over and we take a look, there are some sort of really, I would call them, I don't know if I'd call them non-financial, but they are sort of more operational considerations of that mix. Okay, for example, when you start to borrow significant amounts of capital through bonds or whatever, you could start to have to incur this issue of loan covenant. Loan covenant starts to say, well, look, if the debt to equity mix starts to come too far out of balance, the debt is going to be automatically due. Okay, this is a loan covenant. So bondholders will do this to protect themselves. We don't want you to borrow yourself into bankruptcy. So you have to maintain a certain mix of equity and debt, or maybe even your shareholders don't want to dilute the control of the company to such an extent we're using a lot of voting stock, et cetera. So the debt covenants are designed to protect, really, when we talk about debt covenants, loan covenants, those are really designed to protect the bondholders to a large extent. Okay. Now you come over, at least from the standpoint of at least from the standpoint of the bondholders, that's how they look at them. Now the company may look at it and say, well, what would be the motivation of the company to agree to a loan covenant? Well, the company may look at that and say, well, if I do this and people read in our disclosures about our loan covenants, then they are going to be more inclined to go ahead and be comfortable loaning us money because they know that I'm going to be limited in terms of the amount of debt I'm going to be able to issue. If that's the case, do you think a company do you think a potential debt investor in our company, purchase of our debt, would be expecting more interest or less interest from us? Less interest, right? So from the company standpoint, they may agree to something like that because it's going to give them a better interest rate, right? Okay. All right, good. Now, we've already talked about growth rate, and in the questions, they gave us the growth rate. The examples that we were looking at earlier, okay, they gave us the growth rate. We didn't get any questions, but they gave us an example. But if you have to calculate the growth rate, okay, then we would go ahead and calculate it this way. And so you can go ahead and flashcard that, okay? And we basically have in the numerator, what is the return? And then in the denominator, we have what? 1 minus the return on assets as the base. But we need to consider what is the retention rate of our earnings, okay? So the retention ratio is really going to be whatever our net income is minus the dividends, right? So if we have $100 of net income, but we know we're going to pay what, $40 out in dividends, then we're only going to retain what? We're only going to retain 60% of our income in retained earnings. That's how you would calculate that retention rate. So we come over and they give us an example. Company calculates return on assets of 7.4%, and they have a policy of paying out 40% in retained earnings of our, not of retained earnings, but of our income in the form of a dividend, our earnings in terms of a dividend. Then if that's the case, what? We're only maintaining or retaining, right? Retained earnings, retention, 60% of that. And so we take the growth, 1 minus the growth, adjusted for the portion as retention, and our growth rate in our retained earnings would be 4.7%. And we could use that then to figure out what our growth rate is. Okay. Now you come down and there are different profitability measures that we're going to look at here. So again, we'll get into ratio analysis a little bit later. I tend to kind of, go quickly through these financial measures like this because I feel it starts to become me just reading off ratio to you, okay? We're going to flashcard these here, but we will see a little bit of a repetition of some of this when we start getting into financial ratio calculations in some of the later chapter. They kind of dump all the ratio in one of the modules in a later chapter, and then you're going to see all these again. But let's look at them here since they are here. So key financial measure of success for a company is profitability. And we have these different profitability measures: return on sales, return on investment, and return on assets, and return on equity, okay? And so you could go ahead and take a look at these, but we have return on sales, which is income before interest, interest expense, and taxes. Now, sometimes when I look at that number, okay, I see operating income, is a, and that kind of that can be that same number, right? Because we have operating income and then we start dealing with interest income, interest expense, and taxes when we calculate net income. Okay, so you may get the net income number, and then you'd have to know that you have to add back the interest and the net of the interest. Well, I don't know, it depends. You could have to subtract or add. It depends on whether your interest expense is more or less than your interest income. And then, of course, you would have to add back the taxes, and that would give you the income before interest income, interest expense, and taxes. But if they gave me operating income and that's all they gave me, then I could use that number, right? And then that's going to give you the numerator. The denominator is going to be your net sales. Remember, net sales is what? Sales minus any returns, minus any discounts, right? Again, they'll probably give you the net sales, but be careful. You would maybe need to remember to adjust that if they didn't tell you, if they just gave you gross sales, and then they gave you some information about returns or discounts. Okay. Now, return on investment is simply net income divided by the average invested capital. And sometimes students have trouble with the average, what that means. Okay, what you do is you take the invested capital at the beginning of the year, invested capital at the end of the year, and divide it by 2. Okay, now sometimes I have students say, well, why do I divide it by 2? Well, you have 2 numbers in the numerator. So to get the average of those 2 numbers, you do what? You divide them by 2. And they're using the beginning and the ending because, it's kind of one of these things. It's a rough approximation of what the return on investment is. You wouldn't do this if you were building a bridge. You wouldn't measure the wind at the beginning of the year, measure the wind at the end of the year, divide by 2 and say, hey, there's the average wind throughout the year. You don't do that for an engineering project because the bridge is going to fall down and people are going to get killed. If all we're trying to do is come up with an approximation of a return on investment, okay, let's just give it a lick and a prayer at the beginning, the end, divide by 2 to get the average. Okay. For return on assets, okay, same sort of approach. The average divided by the net income, and then return on equity, the average equity divided into the net income. Okay. All right. I don't have a whole lot more to say than that. I mean, you can see that if you got a problem and they give you those elements, you would need to know how to calculate that. So flashcard those formulas. Okay. Now let's talk about leverage, and we're going to talk about 2 different types of leverage here. We're going to talk about our operating leverage, and then we're going to talk about our financial leverage. First, talk about operating leverage. Operating leverage, we're going to look at what the text says to us here in a second. But basically what we're saying is you have more operating leverage if you have more fixed cost. Fixed costs being what? Costs that don't change as our level of product increases. So typical fixed costs are things like depreciation, rent that we have to pay that isn't going to change depending on our production. Variable costs, as you know, tend to be what? Direct materials, direct labor. Okay, so what happens if we have a company that has a high fixed cost? We consider them to be highly leveraged because once we have what? Covered our fixed cost, right? Then most of our all of our contribution margin after that will go towards what? Will go towards our profitability. So the idea is, hey, once you get over that hump of your fixed cost, you're going to see a steep increase in your profitability. Okay, so with that as a visual, guys, I'm going to now, as the sun starts to go down, I'm going to stop the video. So okay, let's go ahead and I think it's at some point when the shades are closed and it's getting to this twilight time of the evening, I think I look like just a shadowy figure here. Okay. All right. So let's just go ahead and let's take a look at the operating leverage. And again, definition. It is the degree which a company uses fixed operating costs rather than variable operating costs. Capital intense industries often have a high operating leverage, labor intensive industries generally have low operating leverage. You can flashcard all that. They say labor intensive because more direct labor, and also, direct materials would also be considered, something that would lead to having a lower operating leverage versus an entity that has a higher fixed cost. Okay, so what happens? The more the fixed cost, the more the operating leverage. The lower the fixed cost, the lesser the operating leverage. Why don't we go ahead? We can do that. Flashcard, fixed cost. Okay, and what leverage? Operating leverage. We can put over here. Fixed costs are up. What happens to operating leverage? Guess I should do it like this. Fixed costs are up. What happens to operating leverage?
It would go up.
It's up. Good. Fixed costs are down. Operating leverage is considered down. Okay. And the idea here is we're simply trying to get over that hump, if you will, of the fixed cost, and then what our contribution margin is going to go towards our profitability. Okay. Now let's take a look though at some of the implications here. And kind of think once we kind of understand this here, that you could flashcard that if you want to, then we will start to, but I did say why. I don't know why I'm saying flashcard again. I already said that. Okay. Once we understand that, though, I think we can start to really appreciate these implications a little better. So, a company with a high operating leverage must produce sufficient sales revenue to cover its high fixed costs. High operating leverage is beneficial when sales revenue is high. High contribution margin indicates high operating leverage. So we got a nice sales coming in, we got a nice contribution margin coming in. That's going to more quickly contribute to our fixed cost. And then after that, everything is going to come to profit. A company with a high operating leverage will have greater risk. Excuse me. Will have greater risk because what? We got to get over that mountain, and as we're kind of trying to get over that mountain, it's a little bit scary because we got to cover those fixed costs before we're going to have that profitability, and that fixed cost mountain is a little steep, right? Okay, but greater possible returns, okay, and we may have higher variability of profits from year to year, because if there are years in which sales are down because we got that big mountain we have to get over and sales are down, then we may be showing losses or very low net incomes if we barely crest that, right? Whereas if we're having a year that's particularly good, we blow over that mountain and now everything's going up towards a profit. Okay, so kind of the opposite here. When sales decline, a company with a high operating leverage may struggle to cover its fixed costs. However, beyond the break-even point, the company will retain a higher percentage of its revenue towards its operating income. And guys, I think as you can see, as I was mentioning before, operating income is analogous to earnings before interest and taxes. Excuse me for 1 second, guys. I'm gonna have to. I'm assuming these are allergies because I don't feel sick, but it's just I sneeze and all that nonsense. So, okay. Anyway, the operating income is analogous to earning before interest and taxes. So that's why I say be careful when you look at a question. If they give you operating income and you're trying to calculate one of those ratios that needed income before interest and taxes, and everybody gets all excited. Oh, it's EBIT, it's EBIT, it's EBIT. And everyone kind of forgets sometimes that they're talking about operating income in many cases. So if they just give you operating income number, know that you can use that if they don't start calling out interest and taxes in the question. Okay, all right, let's look at just this one example. I feel like they go a little overboard with the examples here, but let's look at this one. So we've got this Pat Jones compared his company's operating leverage with competition's operating leverage. Jones found that his company experienced a 21% increase in EBIT as a result of a 5% increase in sales, while competitors experienced a 10% increase in sales as a result of EBIT as a result of 5% increase in sales. So Jones Company is what? Jones Company is higher leveraged. Okay, what happens? A relatively modest increase in the sales increase. They got what? They got a better return, better net income for those returns in increases in sales. Okay. Okay, good. We don't have to go through every single one of those. Now, we said that there are a couple of different leverages here. One is going to be the operating leverage that we just talked about, but there's also financial leverage. Now, what financial leverage says is, hey, if you take on debt, okay, as long as you generate enough income to cover any fixed interest costs, okay, then at that point in time, what you start having the sales go towards income because you covered your interest costs. So you could also have financial leverage. So financial leverage is the degree to which a company uses debt rather than equity to finance the company. So let's just flashcard that. And then you start to take a look at the implications here. And a company issues debt must produce sufficient operating income earned before interest and taxes to cover its fixed interest costs. However, once those fixed interest costs are covered, additional EBIT will go straight to net income and earnings per share. Okay, now a higher degree of financial leverage implies that a relatively small change in earnings before interest and taxes will have a greater effect on profits and shareholder value. Another benefit of financial leverage is that interest costs are tax deductible, whereas dividends are not. Why don't we flashcard that? Okay, when I hear the text like this starting to call out to us advantages, disadvantages, I start to hear a essay question. I start to hear a written communication question potentially coming up. So I will often ask you to flashcard advantage, disadvantage discussions in here because I could see they're asking us what. And they could ask us a written communication. What are the different, they often will say, your client has asked you, what does the term leverage mean? What are the types of leverage? Okay. And what are the advantages, disadvantages to these leverages, right? And so your answer would be there are two types of leverage, financing leverage and what we already spoke about, operating leverage. The advantages of operating versus the disadvantages of operating, the advantages of finance versus the disadvantages of finance. You got 6 things to write about right there. You kind of jot that down in a quick little outline, and then you go ahead and fill in your outline for your question. You're going to be maximizing the points on those written communication question pretty quickly. You just spend, remember, we said about 15 minutes per written communication. Okay. Now you come over and they tell us that companies are highly leveraged. Companies that are highly leveraged may be at risk of bankruptcy. Okay, there you go. There's another disadvantage. If they're unable to cover their interest costs and then you start defaulting, you're not going to be able to raise much capital, much debt capital in the future. Okay. Okay, good. Now you come over and I'm not going to read those financial leverage examples. There's like, how did you get more financial leverage? More debt equals more financial leverage. Okay, but take a look and they tell us the value of a levered firm. And a levered firm is a company that has debt in its capital structure, whereas an unlevered firm only has equity and no debt in its structure. Okay, so flashcard that. And then they give us the formula for calculating the value of a leveraged firm. And so let's go ahead and I guess we're going to have to memorize this formula here, which is the value of an unlevered firm plus the present value of interest tax savings. Okay, and so this would of course be given, and then we'd have to sort of do our calculations over here for the present value of interest and savings, okay, which is really where the formula comes in. And it's the tax rate times the interest rate times the debt divided by whatever the amount of the debt is. Okay, and that's going to give you the value of the leveraged firm. And so you can take a look at the example over here, which just uses numbers and uses them for the formula. And they tell me the value of the company with no debt. The unlevered firm is what, 130. The company has recently issued 25 million of debt, and the interest rate on that is 5.75. And they give you the corporate tax rate is 30%. Okay, so here I figure out the tax savings on that debt divided by the interest on that debt, and I add that to the 130 million, and that gives me the value of the levered firm. Okay, now as we start to take on debt, that is obviously going to affect various ratios that are used to evaluate companies. Okay, so let's start to take a look at those. Obviously, the more debt you have, the higher your debt ratio. Okay, so if you need to flashcard that, you can. That's probably one of the easier ratios to remember. It's the liabilities divided by the assets. Debt to equity ratio, flashcard that, but that's pretty easy. It's simply the total debt divided by the total equity. Okay, come over and equity multiplier. Okay, and that one you might need a flashcard. You need to flashcard these guys. Don't mess with these, just flashcard them. In fact, look around in your Becker flashcard, and it doesn't have to be limited to the chapter 3 cards. Look up some of your ratio and some of your other modules. I think it's chapter 5 or something. You know what? I'll take a look a little bit later and tell you what chapter where they go through all the ratios with you. There's one chapter where they really hone in on the ratio. And that's probably where to look to find these flashcards if you don't see them in this particular chapter. I forget which chapter that is. Let me see. No, it's not coming up at me that quickly. But look around in the flashcards, okay, because I'm not seeing it. I'm not sure exactly where they put it, because there are different ratio for the formula and stuff. So maybe most of them are in this chapter, guys. Okay, so maybe that's where most of them are. So when you're going through this chapter material, I guess the best thing for you to do is go ahead and find the flashcards that they find the flashcards where they've talked about these ratio to you, and make sure you've got them all memorized. And I have a feeling that most of them are here, but if there's one of the formula that we see here that aren't in your pre-made flashcards that came with your package, then add that flashcard. Okay, good. And then times interest earned is going to be that EBIT, or potentially operating income, okay, earnings before before interest expense. Well, it's just interest expense there. So if you had interest revenue, you'd have to ignore that. So you couldn't pick up operating income. So it's just interest expense there. And divide that by the interest expense. That gives you how many times your interest expense you've earned before tax. Okay. All right, good. Let's look at this question and then we're going to take a break. Okay, guys, we're going to go ahead and end the poll here and take a look at this one. That's about 2 minutes. So I think most of you, got this pretty quickly here. This is a question that really should probably take you, maybe 30 seconds on exam day. Okay, but let's go ahead and let's take a look. And they give us this information and then notice there's no numbers in the choices. Okay, so you start looking and they say the financial leverage of the company would increase if what? And I didn't ask you for a flashcard like this for the financial leverage. But let's just go ahead and do that flashcard right here. Okay, so what happens if we're talking about financial, and maybe on that other flashcard, did I call it out as operating leverage or did I just say leverage? So we should probably be more careful on that other flashcard. Did I call it as operating or did I just say leverage?
You said operating leverage.
Did I? Okay, good. Okay, because there's thank you. Because there's financial and there's operating. Okay, so for financial leverage versus what? Versus debt financing. And of course, they move in the same direction, right? So higher financial leverage with higher debt financing, lower financial leverage, right? With less debt financing, or you could say, if we do, here we go. If we try to put equity in there, I'm just going to put EQ for equity since I squeezed myself into a hole. We have equity financing. If equity financing, oh, well, forget it. I think okay. More debt financing, let's just look at it because more debt financing means what? Less equity financing. Okay, so what happens? So my equity financing, maybe I can't do it. If my equity financing is down, then my financial leverage is up. If my equity financing is up, then my financing leverage is down. Yeah, I guess I can do it that way. Okay. So you look at that, the financial leverage would increase as a result of, and just looking at our flashcard, D is wrong. Higher percentage of equity. No. Looking at C, issuing its future investment with a higher percentage of bonds. Bonds are what? Our debt financing. So that's the right answer. Issuing common stock. That's doing what? That's going with that's probably going to be pretty much a wash. Okay, as we're replacing one vehicle of equity with another one. Okay, issuing common stock and using the proceeds to retire bonds, that's reducing the financing and increasing the equity. Okay. Okay, good, guys. Let's go ahead. We're right up on 6:30. Let's take our break. We'll go to 6:40, and then we'll come back and pick up with module 3. Okay. All right, good. So we're going to start to look now at working capital, okay, and understand some different ways of evaluating our working capital. When we look at working capital, we're thinking short term. We're really thinking more about the solvency, liquidity of the company, okay? So working capital is basically our current assets minus our current liabilities. Okay, so obviously we want this number to be greater than 1. If this number is negative, we've got some problems because we're probably not going to be able to meet our short-term obligations. Now, we don't want the number to be gigantic to a point where we're maybe hoarding some of our current assets, probably cash, because now investors may look at that and say, well, hell, why should I hand you my cash if all you're going to do is hang on to it and not have it working productively in the company to increase the wealth of the shareholder, the profitability of the company and whatnot. Now, you can turn that into a ratio, okay, and you can go ahead and flashcard that the current ratio is our current asset divided by current liability. And of course, we want that number to be greater than 1. But again, you don't want it to be so gigantic that it indicates that maybe the company isn't productively using and everybody's favorite asset, everybody's favorite current asset is what is cash. So you don't want there to be an implication that maybe you're holding on to cash when you should be using that to increase the profitability of the company and whatnot. On the glasses here, guys. Oh, something that I remember during the break about the ratios. The other thing you can do, I know that in chapter 7 of the FAR book, they have a whole module that talks about financial ratios. So you can look at those flashcards. And if you see one of these ratios that we're talking about in the flashcards for F7, because you do have the access to those in your software, then you can pull them in to help you to study for the BEC exam, to save you having to write all these flashcards, because we are going to be seeing that for a lot of these ways of evaluating our financial performance, our working capital, for example, we are going to be using quite a few ratios that I am going to ask you to dedicate to memory through flashcards. Okay, so you come over and continuing with that theme, okay, we talk about the quick ratio. Now, quick ratio is a more critical measure of the company's solvency. Notice current liabilities are still in the denominator, but when we get to the numerator, we start excluding certain current assets. Specifically, you can even write in here, no inventory. Okay, we don't include inventory as a current asset because, hey, maybe we're in a situation where we cannot sell our inventory quickly enough. Maybe we have some items that aren't moving very quickly. So we would take the inventory out. The other thing that's here, no prepaids. Okay, prepaid is a current asset, but it's not a current asset that you can liquidate into cash. It also, we would also exclude prepaids here. Okay, like a prepaid insurance, etc. When we talk about net receivable, guys, I think you know this, but don't forget that that's accounts receivable minus what? Minus the allowance for doubtful accounts. Okay, all right, good. And notice, as I've already indicated, the quick ratio is a more rigorous measurement of our, I think I said solvency, but it's probably liquidity is a more correct term. So you can just go ahead and flashcard that. Okay, now cash conversion cycle. Okay, now cash conversion cycle is not going to be a dollar amount. It's going to be amount that is going to be measured in days. Okay, in days. So sometimes students want to look and they want to calculate, they think that there's a dollar answer to that question. It's days. Okay, and so you come over and you can see days, 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 right? And so we add the days that our items sit in inventory. We sell something on credit. So how long do we have to wait till actually collect on that? That's measured by the days in accounts receivable. But we also have some period of time before we have to necessarily pay our bills. And so we can subtract off of that the days of our that we're able to have our payables in outstanding status. Okay, now they give us a different way of calculating the days in inventory, and I don't like it. Okay, I like to do it this way. And you can choose to do it the way they're showing if you want to, but the first thing you have to do is, regardless of if you do it my way or their way, is you have to calculate the inventory turnover. Okay, the way to think of inventory turnover is how many times would I sell out of my inventory in the course of a year. Now, of course, you don't actually sell out, but if you take your cost of goods sold divided by your average inventory, don't forget average is always the beginning plus the ending, what, divided by 2, right? 2 numbers in the numerator, divide that by 2 to get the average. And even though you may not actually ever sell out, you're really kind of saying, well, this is how many times I rolled through my inventory. We call that inventory turnover. And then to get the days in inventory, Becker thinks that you should take the ending inventory, divide that by the cost of goods sold, and divide that by 365. I'm not feeling that one. I like to take the 365 day year, right? 365 days. And I like to divide that by the inventory turnover, right? So if you turn over your inventory, just to make the numbers easy, 36 times, then what happens? Things sat in your inventory on average, about 10 days, right? Okay. So I like to divide it by the inventory turnover. It just feels more logical to me when I do it that way. If you like the way they're showing you, you could do it that way. These will both give you the same result. Okay. Okay, good. Now you come over and you take a look at days in account receivable. Okay, now you can flashcard that or find it in your flashcards, even look at the financial cards for chapter 7 over there. But sales net, we know that sales net, to get our account receivable turnover, sales net is the sales minus discounts and minus returns. But what kind of sales are we talking about? We're talking about credit sales here. Be careful, because the book should have put that, because the exam may give you cash sales, may give you credit sales. It's only what credit sales. We don't have to wait to collect on a cash sale. It is already cash, right? Okay, so it's credit sales. And then again, they've got this thing where they get fancy, in my opinion. It just works better for me to take the 365-day year, okay, and divide it by the what? Accounts receivable turnover that I just calculated up there. And that tells you how long it takes to collect your receivable. Now, where inventory, there is no official number as to how long it should take us to turn over our inventory because industries are different. If I'm looking at a real estate entity, it might take me depending on the market, but it might take me 60, 90 days just to turn over things, even in a good market, because I have certain, proper, due process that I have to go through to be able to sell a real estate item. If I'm talking about a sushi restaurant, well, if it takes you, 30 days to turn over your inventory in a sushi restaurant, don't eat there, okay, right? Whereas if we're talking about accounts receivable, I think it's reasonable for most businesses, we would expect this to be what? A 30, 60 day an account receivable. I mean, you don't want to be waiting, forever to collect on your accounts receivable. So we're seeing a period that's going outside of a 30, 60 day period. This entity probably has some problems with their collection process, right? Their credit process, whatever. They probably are giving credit to folks that are having trouble paying on time. Okay, and then the day the payable are outstanding, and just taking a look at that, accounts payable turnover is the cost of goods sold divided by the average account payable. And then again, they do that sort of fancier way that I don't care for. I just would like to go ahead and take the 365-day year and divide that by the AP turnover. I don't know which one's more scientific or what, okay? Be careful because sometimes you see we use a 360-day year. We use a 360-day year when we're actually calculating financial kind of measures, dollar amounts, because when you think about it in accounting, for example, when you do depreciation calculation, you divide by 12. Well, whether you realize it or not, that was the same as saying that every month has the same number of days, right? And so you'll sometimes use a 360-day year for some things. When you're actually measuring days, okay, as opposed to dollar amounts like you are when you calculate your depreciation, then you should use the 365-day year for that. Okay, now you come over, and I'm not going to go through each one of these examples, but I do want you to put down that this could be a good example of a task-based simulation. Okay, I'm not going to go through, guys, the calculation of each one of these. I think that you're well off to be able to, you're well trained enough to be able to read that on your own and understand that. Okay, but let's look at the analysis. Let's see what some of these things mean. Okay, and let's flashcard some of these, because again, I want you to come in equipped with ready to write about what these different ratio means, or these different calculation days, I should say, mean. So they may ask you to do some calculations, or give you some numbers and expect you to be able to do the calculation of the days, and then expect you to write about what you're seeing and what it means, right? So let's get us ready with some flashcards there. So days in inventory. Okay, and a company's doing well when it quickly converts its inventory into sales. More days in inventory could mean that the inventory is becoming obsolete, right? We're not going to be able to sell it. If the days in inventory is too short, the company may not have enough inventory on hand to support potential sales. Well, just go ahead and flashcard. Those are two different analysis, or two different conclusions that one can come to by looking at the days in inventory. Days in accounts receivable. Fewer days in accounts receivable is ideal, although a company may lose sales if its credit terms are too strict. Maybe they're making folks pay too quickly, and they can give a little more time and still be okay. Too many days in accounts receivable indicates the company is struggling to collect from its customers. Okay, so flashcard, that has two different conclusions that can be reached by evaluating the days in account receivable and days in account payable. Company converts cash by delaying payment to vendors on credit. Okay. Too short of a period represents the risk of not fully utilizing the cash to the company's advantage. Too long of a period may cause the company relationship to vendors to deteriorate. And you can also write down and may indicate cash management problem. I'll read that back to you. It also may indicate cash management problems. Maybe they don't have enough cash and they're having to take too long to pay these bills. Okay. May indicate cash management problems.
Question.
Yeah.
For an essay question that might potentially touch on this, would another point be that if it's too long, they might be missing out on discounts for paying quickly, like net 10 or 2% 10, net 30?
Yeah. Maybe missing cash discount opportunities. Okay, and Michael, what I'm thinking as you kind of, we're kind of doing a little brainstorming here on this. And so you may also write further, let's say in an essay, further analysis of cash discounts lost may be warranted. Because when you take the cash discount, right, typically what you're going to do is sometimes you'll see they'll tell you to just credit the inventory account and debit the payable for the amount of the cash discount taken. But if you wanted to really understand to what extent the company is using those cash discounts, then you'd still want to credit the inventory. Let's see. You'd still want to debit the account payable because you don't have to pay them as much. But now you would credit cash discount taken, and then that would ultimately be closed out to the cost of goods sold for financial reporting purposes. But for company evaluation purposes, you may want to use cash discounts taken and lost account to be able to analyze that. Is that making sense?
Yeah, that does. I'm just trying to think about the essay question because that's the one I'm worried about. I hate writing.
Well, I wouldn't worry too much about it. I'd really put that, on the back burner, on low heat as a worry for the BEC exam, because remember that they're grading you on your grammar as well as the content of your answer. And so, for example, let's say the essay question here said, calculate the ratio, some ratios here, days in inventory, days in account receivable, days payable, outstanding. Your client has asked you what these mean. And in your essay question, you would say, dear client, you have asked me to evaluate the days in inventory, days in account receivable, days of payable outstanding. By looking at these, or then maybe they just ask you what's the cash conversion cycle, right? The cash conversion cycle is made up of days in inventory, just by mentioning cash conversion cycle, just by remembering to mention days in inventory, days in account receivable, days in payable, and having those terms called out in your answer, points, 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 points. Even if you effed up the analysis, like you've got everything in here backwards. The fact that you're mentioning the days in inventory, the fact that you're mentioning, the company's turnover, gives you points. And if you're using grammar, even if you completely swung and miss on the logic of it, you're still going to be getting some points for writing, using the terms that they ask for, and using proper grammar. Remember, there are people sitting in Japan right now that are getting ready to take the CPA exam, and their score will be evaluated against your score. There are people, in Brazil that are going to be getting ready to take the CPA exam. There may be people traveling to the US, but there are, residents in another country where English is a second language, and yet you're coming in using English in a business setting on a daily basis, writing your memo, so your essay questions. So I would say everyone in this room will do very, very well on the written communication question, as long as you are careful to be responsive, use good grammar. Yeah, flashcards, some of these things that I'm talking about to help you to get the points there. And then make sure that you don't go overboard, don't show off, blowing up a bunch of time, writing this genius answer, because of the 3 task-based simulation, one of them isn't graded. So I wouldn't worry too much about it.
Thank you. That makes me feel a little better.
Yeah. Okay. All right, good. And then working capital turnover basically takes your average working capital beginning plus ending divided by 2 and divides that into your sales. Okay. Again, working capital is current assets minus current liabilities. And then let's take a look at the analysis of that, and let's flashcard that for our essay question insurance here. A higher working capital ratio implies the company is doing a relatively good job converting its working capital into sales. Too low of a ratio implies too much money is being invested in current assets, such as receivable and inventory relative to the sales the company is generating. And too high of a ratio implies that there may not be enough capital in place to continue to support operations sale. I got this big sales number is being, it's being balanced off of this little tiny working capital. So, okay, good. Let's go ahead and let's take a look at some multiple choice questions for this module. Okay, most of us have answered this in less than a minute, which is good. The sad part is that almost everybody missed it. Or not everybody, the majority of us missed it. Be careful, guys. Read questions carefully and don't just lock in on that first answer just because it sounds right. Okay, so 60% of us chose A, meanwhile that's wrong. Okay, so which of the following would increase the working capital of the company? Well, the working capital is current assets minus what? current liabilities, and if you convert receivables into cash, you've had a wash here. It's changed nothing. The current asset number has stayed exactly the same. Right? Cash is a current asset, account receivable is a current asset. Guys? Hello, this thing working?
Sorry, I'm just trying to process it.
Well, look, it's not hard. If I have $100 of accounts receivable and I have 0 cash, okay, my cash is 0. My accounts receivable is 100, and say my current liability is, 50. My working capital, I don't want to get 50. Let me make my current liability is 40. My working capital is what?
60.
60. Current assets minus current liabilities equals working capital, right? If all I do is collect on accounts receivable, just to make it obvious, let's say I collect all of that. Now my accounts receivable is what? 0. My cash is what? 100. My current liabilities are still 40, so my working capital is still 60, isn't it?
Yeah. Okay, yeah, that makes sense.
Okay, so, well, it's just the, I'm not trying to belittle it or anything, but don't overthink it. Both are current assets. Cash and accounts receivable are current assets. Okay.
Yeah. I think where I got tripped up is when I think about the cash flows statement and, AR, AP is also working capital in there and yeah, never mind. It's fine. I get what you're saying just because of the definition of network.
Yeah. Yeah, okay. And then B, refinance account payable with 2-year note payable, what's gonna happen? Just use them same numbers. Let's say that I went ahead and I had the $100 of accounts receivable and I had, current liability account payable of 40, okay? That makes my working capital 60. Well, let's say that I go ahead and I refinance that account payable with a longer term item, then what? Then my cash is 100. My accounts receivable is still 100, but now my let's say account payable is 20 because I've refinanced half of that. Now my working capital is 80. The remaining 20 in this example is now down in the long-term liability because it's a 2-year note, and that's not going to affect my working capital. Cash payment of accounts payable is going to be a wash. It's going to go up, it's going to go down. Payment of a 30-year mortgage payable with cash is going to do what? Payment of a 30-year mortgage payable with cash is simply going to reduce my working capital, right? Hello?
Yes.
Okay. Okay, good. So A is the correct answer here. Okay, good. Let's take a look at number 2. Okay, most of us had a chance to take a look at this one, so I'm going to go ahead and end the poll. It looks like everybody got this right, so that's good. Okay, well, most of us got this right, but let's go ahead and let's take a look at this now. You okay, Sam?
I'm excited.
Okay, now, when you look at this, they're asking us what is going to affect what? Current ratio, which is what? A balance sheet implication, and what? It'll increase and decrease net profit, which is a what? Income statement implication. So when you just go through the choices like that, I think, Sam, that's why you kind of, oh, what did I do here, right? Dividends paid does not affect the income statement. So it's gone, right? Dividends are not an expense. We just direct subtract from the statement of retained earnings, okay? Then you start looking and you see, well, a federal income tax payment due from the previous year is paid. That's a purely what? That's a purely balance sheet item. Paying and payable only affects the balance sheet. It will not affect profitability. Okay, so then you start to look at these others and okay, if I'm retiring a bond, if I'm retiring land, yeah, I will probably have what? Both an effect of the balance sheet and the income statement. Now, if you look at B, which was also incorrect, if I retire a bond before maturity at a discount, okay, what that's telling you is I went and retired that bond and I had to pay less than the carrying amount of that bond. Well, if that's the case, that's like getting to pay off your mortgage for less than you owe on it. That's going to be what? That's going to be a gain. So that's going to increase the profitability. Selling a vacant land is sold for less than its book value. That means I'm going to suffer a loss, right? If the book value was 100 and I only sell that thing for 80, the cash is going to come in at 80. I'm going to credit the land for 100 and I'm going to be doing what? I mean, the land, I sold it for less than its book value. So the land would be, in this example, 1,000. Okay, so I'm going to have to do what? I'm going to have to debit loss 200, and that's going to decrease my profitability while increasing my current ratio because what? Now I have more current asset cash, and the liability section of the current ratio is not affected by that transaction. Okay. I think now that I look at it, what makes B wrong is retiring a long-term bond. Oh yeah, it would have a cash effect because I'd have to retire it with cash. So it probably wouldn't. It wouldn't increase the current ratio. It would do what? Decrease the current ratio. So the analysis really is more on the balance sheet part of that transaction than the income statement part. Okay. Okay, good. Now we come over, so I don't know that I can necessarily tell for sure if that was a gain or not. Now we come over and guys, as I recall, we did this last time, module 4, correct?
Correct.
Yes,
Okay. Okay, so I'm going to, there are no questions on any of that we talked about last time. I'm going to go ahead and flip us to where are we?
Should be page 41.
41. Okay, I'm gonna get there. Oh no, I can do it this way. Yeah, okay. 41, you said?
Yes.
Okay, thank you. Okay, good. Now, some of these things we've already been talking about, and we started to get into some, more of these ratio. And I just want to, kind of point you to the repetitive nature of some of this, and that they started having us calculate the accounts receivable turnover and the days in accounts receivable, which we've already calculated those. Okay. Actually, days sales and accounts receivable, maybe we can look at that because that's a little bit different. It's not days in accounts receivable, it's days sales and accounts receivable. So key component of cash conversion cycle, this is how many days on average it takes a company to convert its credit sales into cash. So it is a little bit of a different calculation than what we're doing for days in account receivable. It's the ending account receivable, divide that by the sales times the number of days in the period will give you the days in account receivable. So I guess that one is a little different. Okay. Now, what we start getting into here that I want to focus on quickly, again, and we're going to flashcard some of these, are methods to speed collections. Okay, and we're going to just go quickly at a high level here. Customer screening and credit policy. If you make sure your customers have good credit, you're more likely to be able to collect on them, right? Prompt billing. They don't know to pay you unless you give them a bill, right? Payment discounts, again, offering a discount that will get them to pay you more quickly. Okay. Expedite deposits. Okay. And a couple ways to expedite deposits is by electronic fund transfer. Just have them transfer the money so you don't have to deal with checks. Lockbox system, have all payments go directly to the bank, so you don't have to then collect the receivables, and then there's a period between the time that you collect them in which they get deposited to the financial institution. You use a lockbox, the payments go directly to the the bank. Okay. Also, concentrating banking is characterized by the designation of a single bank as a central depository. It improves controls, reduces idle balances, and improves effectiveness for investments. Okay. Factoring. Okay. And there are different ways to calculate factoring, and I'm not going to go through this example because I feel like this example is a little too granular and specific for our purposes. But just to understand the notion of factoring, and guys, flashcard these things I highlighted at a high level, all the ones I highlighted at a high level. Okay. And then that includes this factoring as a way. But what we do with factoring is we have accounts receivable, and we go to a factor and we say, look, give us the cash up front for these receivables. Give us the cash up front. And what we'll do is we'll give you the receivables, and then you can collect on the receivable. And the factor will generally charge us a fee for that. So we're getting our money sooner. Now, we're not getting as much money. Maybe the factor will charge us 2% on that or something, but at least we're getting the large chunk of our cash up front because the factor pays us that. And they get into a factoring calculation here in this example as though there's just one way to calculate what your return is on factoring. And I think that kind of is a waste, because there could be different ways to calculate gains and losses on factoring that don't contemplate everything in this example. Okay. Okay, good. Let's come over. We could use a letter of credit. Okay. A letter of credit represents a third-party guarantee to give us money, essentially, to help to cover any financial obligations of the company. Line of credit debt typically is a revolving loan with the bank. They have a line of credit. You can borrow 50,000 a month for the next year or something, would be an example of a line of credit. We've already talked about debt covenants. Okay, with a debt covenant, creditors may use that in lending arrangement to protect their investment by limiting or prohibiting the actions of the debtor that might negatively affect the positions of the creditors. Once your debt to equity ratio gets out of whack, you're gonna have to pay a certain portion or all of this debt immediately. From the standpoint of the company, what's good about entering into these debt covenants is then potential creditors know, well, okay, I'm not going to be as concerned about some sort of default risk, so I won't require as high of interest. So it could actually allow the company to save interest costs. Okay, so some common debt covenants: limitation on additions to additional debt, restrictions on the payment of dividends, limitation on the disposal of certain assets. Maybe the asset, they have perfected their their claim to that particular asset. They've attached a certain claim, which we get more into the regulation part. But if that's the case, then they would have a certain protection that if we sell that asset, we have to immediately liquidate that debt. Okay, coming over and taking a look at some comparisons between short-term and long-term financing. Okay, and so let's take a look at those. Short-term financing has a situation. The rates are probably, first of all, short-term is more mature within a year. I think you know that. But rates are generally lower with short-term financing because the creditor isn't locked into a maybe lower interest rate when interest rates are going up, right? So they don't want to be locked into that. So they'll offer us a lower interest rate for short-term. The effect on working capital is it will decrease my working capital because I will get a current liability. And so that's going to be a short-term. Well, if I get the cash, they shouldn't say working capital, but the working capital ratio would be decreased as a result. Increases advantages, okay, increased profitability, rapid conversion of operating cycle into cash in order to meet short-term obligations, carries the potential of increased profitability, decreased financing costs. The short-term rates are generally lower, as we said. Here come the advantage, disadvantage monsters. So let's just go ahead and flashcard them. Disadvantage, increase interest rate risk. Okay, if interest rates abruptly change, they're going up, we're locked into all the short-term financing. Now we're going to have to go back out into an increasing interest rate world and get some borrowing when interest rates are going up. Decreased capital availability, lenders may start to look at that situation and say, well, I'm not lending you any more money because interest rates are coming up and you're not going to have a sufficient capital to cover that. Okay, short-term versus long-term. Okay, long-term financing. Okay, rates are generally longer. Effect on the working capital. Long-term finance is non-current. It is not included in the calculation of working capital. Okay, coming over, advantages, disadvantages. Advantage, decrease interest rate risk. Okay, hey, a lot of people locked into a very nice long-term, mortgage rate on their homes when the interest rates were really low, and they're looking about like geniuses right about now, right? Whereas increased capital availability over a long period reduces the company exposure to any risk as interest rates were to change. So you can flashcard those advantages. Disadvantage, decreased profitability because we're paying higher interest. Increased financing costs, okay, because we have the higher interest. Okay, now from the I think that's enough. Okay. Okay, good. Now you come over and let's take a look at this question. Oh, that's what the goal is. Okay, guys, I'm gonna go ahead and end the poll here. So go ahead and make your selections. And okay, I'm a little surprised we didn't maybe do a little better on this one. 56% of us got it correct. The answer is D, but I was thinking we might get more along the lines of 100%. But let's just go ahead and look at this. Now, I'm happy that nobody picked B. Okay, why would a company do anything to lower it? Well, let's make our bond rating lower so that we have to pay higher interest. So, I mean, that's something that could happen to a company, but they're not going to take actions to do this. You know, they say, what is the primary reason for a company to agree to debt covenant? Okay, now you look, and debt covenant, and it says limiting the percentage of its long-term debt. And we say A, to cause the price of the company's stock to rise. Well, if I'm sitting there and I've limited the amount of debt that I can use to finance the company, my only other choice is going to be what? Equity. And the more equity that I am issuing, the more shares there are on the market. Supply and demand law would say that that would cause the company's stock price to do what? To come down, wouldn't it? If I'm issuing more shares, there's more shares out there. Okay, so no, I don't see how that would work. And then C, to reduce risk for existing bondholders. Well, yeah, it would have that effect. Okay, it would reduce the risk. That's the reason the bondholders probably want that. The reason we agree to it, okay, is that what? That then will cause potentially, you know, someone to say, well, okay, we'll give you a little lower interest rate. So our motivation is what? The lower interest rate. Their motivation is the protection, right? Question? Okay, I am going to stop us there. We could try to pick up another module, I suppose, but I don't see any reason to force it. We're making good progress. We will finish chapter 2 next time. That gives you plenty of time to catch up on any undone homework from chapter 1 and make good progress through the first 5 modules of chapter 2. I think the wisest thing for us to do is call it an evening. Any questions? I'll take that as a no. And I will see you next week.
Thank you. Have a good night.
Thank you. Good night.
Good night, guys.
Thanks, Professor.
Good night.